Hello traders, welcome to episode 5 of Nexowell Trading of YouTube Mentorship Program. This mentorship program promises to be packed with well-structured teaching from the very basic in Forex trading to the simplification of complex smart money concept trading methodology. So if you wish to be staying updated and you're new to this YouTube channel, then you should do well to subscribe to be part of this community. Also like, share, and comment as we progress in this mentorship program. So in this episode, what we're going to be paying attention to is actually the Forex pips and pips value. When we make progress, we're going to consider things like the lot size and other important terminologies used in the Forex market that are actually also technical and influence your trading decision. So what is actually the Forex pip? The pip actually stands for price interest points. It basically represents the basic movements a currency pair can make in the markets. And this is what is used to calculate the rate traders in the Forex markets will be paid. So we actually have the pip and then we have the pip value. The pip is actually the basic movements the currency will make, while the pip value is actually the rates a trader is going to be paid in a particular trade that he executes. So you see the pip value is actually how much each pip is worth. That is the pip value. And it is what is used to calculate the rate traders in the Forex markets will be paid. So you can see here, we have the Euro USD pair as an example. You can see we have this price level of 1.17185 and we have the price level of 1.17195. So we basically pay attention to the fourth decimal point because the fourth decimal point is what determines the pips. So what you can see here is that the difference between 9 and 8 is 1. So the fifth decimal is actually pipettes, but then the fourth decimal is where we start calculating our pips. So 9 minus 8 is going to give us 1. So meaning the price movements, we want to assume this is the entry price level here, and then this is the exit price level. So meaning price have moved by 1 pip. So for currencies that appear with the JPY, they're actually in 3 decimal places. So now, what we are going to see in this other example, using the Euro USD, we have this price level as 1.17192, and then we have this price level as 1.17195. What you can see is the fourth decimal place is actually 9 here and also 9 here. So meaning this is actually the 0 pip. But then you pay attention to the pipettes. We have 5 and we have 2. The difference between 5 and 2 is actually 3. So meaning it is what? 0.3 of a pip. This one is not actually to a single pip. It's not actually to a unit of a pip. This is actually 0.3 pips. So we are assuming this is actually our ask price and then these are bid price. So the difference between the ask price and the bid price is just 0.3 of a pip. But when you look at the other example, is that the fourth decimal place we have 9 and 8. So when you subtract 8 from now, we are having 1. 5 minus 5 is 0. That's 1.0. So which is actually 1 pip. So we now want to make reference to the lot size in connection to the pips value, because we actually said that the lot size is actually what determines what the trader is to be paid in accordance to the pip movements. The lot size help determine pips value. So what is Forex lot size? A lot in Forex trading basically refers to the size. It is the size of the trade or amount that a trader trades at any given time. So the lot size is basically what directly influences the risks you're taking. It is the best thing you need to understand before you identify your entry and exit points. So you must know how much you're willing to risk in a particular trade. The lot size is the factor that determines that. So we have the micro lot size, the mini lot size, and we have the standard lot size. So what you can see here, we have this as the micro lot size, 0.01. This is meaning for every pip move, you're going to be making 10 cents. And then this is 0.10. This is actually saying that for every pip move, you're going to be making $1. And this is the standard lot size, which is 1.00. Meaning for every pip move, for every single pip move, you're going to be making $10. So I told you guys that we have the standard lot, the mini lot, and the micro lots. So meaning 100,000 units is what gives us the standard lot. And then the 10,000 units is what gives us the mini lots. And then the 1,000 units is what gives us the micro lots. So this is actually the Euro USD pair. So we are assuming that this is the entry price level, 1.17195. And this is actually the exit price level. You took the trade entry from this price level and then you're exiting at this price level of 1.17395. So you can see that the difference between this price and this price is actually 20 pips. So meaning the market has made a significant movement of 20 pips. Now, when you're using a standard lot of 1.0, which is meaning that a standard lot for every pip move, you make $10. So for this particular trade setup, it is meaning that 20 pips multiplied by $10, meaning you're going to make $200 for this 20 pips movement. So meaning the pip value for this pip is actually $200. And then let's assume you made use of the mini lot size, which is 0.10, which you know that for the mini lot size, the significant value that you gain for a single pip move is actually $1. So meaning you're going to be making 20 pips multiplied by $1, which is going to give us $20. Then for the micro lot size, that is the 0.01 lot size, you already know that the significant movement of a single pip in the micro lot is actually 10 cents. So 20 pips multiplied by the 10 cents is going to give us $2. So meaning for every pip move in the micro lot, you're making 10 cents. And 10 multiplied by the total 20 pips movement in that market, you've made $2. So you can see how pips value and lot size all influences each other. So we must understand about Forex leverage. Leverage is very important to understand because a lot of traders actually do not understand the concept of leverage, and some make use of leverage that end up actually burning them in the Forex markets. So what is actually leverage? Leverage simply means the ability to use a small sum of capital to control a larger sum of money. That is basically what leverage is. It is what the ability to use a small sum of capital to control a larger sum of money. This money is not actually directly given to you, but that is why it is called leverage, meaning your broker can offer you the opportunity, for example, to open a $100 position with just a $5 trading capital. So the leverage allows you to start with a small capital, which is one of the benefits of Forex trading. That is one thing you must understand. So for example, here, what we can see is that the trading capital here is $100. And then what you can see here is that the leverage is 1:10. So meaning you have a controlling capital of $1,000. Meaning with your $100 trading capital, you can open a position worth $1,000. Basically, this is what the $100 capital you're having by the 10 times leverage the broker is offering you. So meaning $100 multiplied by 10, which is going to give us what? $1,000. So if the leverage here is actually 1:20, meaning you have $2,000 controlling capital. This is not cash that is handed over to you. No, this is actually an opportunity for you to use your small capital to control large sum of money. You can open a position of $1,000 with just your $100. So that is actually leverage in the Forex markets. So The more trading experience you actually have, the higher the leverage you can afford to use. That is just what I have to tell you guys. Because some traders don't really have some traders have not really gained proficiency in the Forex technicalities. And then they would want to actually use higher leverages. This can work in your advantage and in your disadvantage. So we must understand again the Forex margin. What is the Forex margin? So the margin is actually the amount of money available in your account or used to open a position. It is the minimum sum of cash you are required to set aside to open a position and keep it open. So for you to actually execute a trade, your broker is going to lock a certain amount once you've placed that position. So that amount that has been locked is the amount that has enabled you to actually execute that trade. So that is what we call margin. So that is why when you check your Melter Trader, you're going to see your balance, you're going to see margin and all other stuff there. So the margin is actually the amount of money that is being used to open a position. So the last part of this episode is actually to look at currency selections for beginner traders. What is required for beginner traders to look out for when selecting certain currencies to trade? You know, we've looked at the major pairs, the minor pairs, and we looked at the exotic pairs. So there are actually several factors that are essential to take into consideration in picking or selecting currency pairs. And one of these is liquidity. And you must understand that I've made you guys to understand that liquidity is actually the amount of interest in the market. So you must check which currency pairs are more traded, which currency pairs have more buyers and sellers interested in those particular markets, in those particular pairs. And we've made reference to what? The major pairs. So the next thing you must look at is actually the spread, the difference between the bid and the ask price. Because you must understand that your broker earns their commission from the spread. And you must also understand that spread also is dependent on the type of currency you're actually trading. And the next you must consider is actually the volatility, the uncertainty about the future price movements, the ability for the market to actually make sharp moves. So you must also check the predictability of that currency. How technically predictable can you forecast the future movements for that particular currency? So guys, let's look at the various types of Forex orders. First on our list, you must understand that we have what we call the market order. And the market order is actually an order to buy or sell at current market price. That is actually now the market order. So it is basically an instantly executed order. And this order is actually suitable for traders who can afford to spend time in front of their screen. Such an order is actually popular among traders. So basically now what you can see in the chart here, we have the Euro USD. So this is actually the bid price and this is actually the ask price. So the moment you turn on your MT5 or your MT4, and then this is actually the current bid price, and then this is the current ask price, and then you click on market execution. So basically what you're trying to say is that you're actually executing that trade at this particular ask price. Let's actually consider you're buying. So meaning you're actually executing it at this particular ask price. So if you want to buy the Euro USD at this market price, then it would be sold to you at $1.2142, the ask price. That is basically the market order. It is an instantly executed order. And the downside actually of entering immediately at the current market price is that this would often prompt traders to enter a trade earlier than expected due to emotions such as possibly greed or FOMO, what we call the fear of missing out. So this is what you have to know about the market order, that it is actually an instantly executed order, an order to buy or sell at the current market price. Then next, we actually have what we call the pending orders. And for the pending orders are actually in two categories. We have the limit orders and then we have the stop orders. And under the limit order, we have the buy limits, we have the sell limits, and then under the stop orders, we have the buy stop, and then we have the sell stop. So basically for the pending order, it is actually a type of order where a trader places his order to be activated in the future time when price hits the trader's expected price level. So that is what you have to know about the pending order. It is not like the market order where it is actually an instantly executed trade. No, but the pending order is actually you look for a price level and then you actually set your order at that price level, expecting that the market in the future would come to that price level and then activate your trade. So basically this type of order is an order a trader actually places to be activated in a future time when price hits the trader's expected price level. So that is what you have to know about the pending order. And the good things about using pending orders is the reduction in the likelihood of emotional trading. Unlike the market order where emotions can really be attached in trading. But for the pending order, you actually make your analysis and then you place your entry expecting price to come activate you later on in the future. So the pending order is actually suitable for those who don't have time to monitor their charts. So let's dwell on the limit order where we actually have the buy limit and then we also have the sell limits. So for the limit orders, the limit order is actually an order placed to either buy below the market or to sell above the market at a certain price. As we continue further, you get to understand what I mean by it is actually an order placed to either buy below the market or sell above the market at a certain price. So the limit order is actually an order to buy or sell once the market reaches the limit price. Limit orders are common among traders who actually trade a pullback or retracements in the price markets. So let's check the chart now. What you can see here is actually we have the buy limit and then we have the sell limits. So you can see here for the buy limit, this is where price is at currently, which is actually the current price. So for the pending order, which is actually in the category of the limit order, and this is actually specifically the buy limits. So this is the current price. So what you're actually saying is you don't want to actually take the entry or execute your trade at the current price. You're looking at executing the trade when the market drops down to this price level, and then you execute your buy entry at this particular price level to trade the markets to the upside. So what this is actually showing you is currently this is where price is at, but then you don't want to execute your trade at the current price. So what you do with the buy limit is that you set it below the current price. So meaning when the market actually returns to the downside, the market would activate your pending buy, and then you will be activated into the buy move, which you have been anticipating, and then you've placed a pending order for. So that is why you would see it is actually suitable for those who don't have time to monitor the chart. And then the limit orders are common among traders who trade a pullback or retracement. When we continue further into the technical perspective of Forex trading, you get to understand what we mean by pullback or price retracement. So this is what you have to know about the buy limits. Then for the sell limits is actually you set your order above the current price. So you can see now this is where the current price is at, but then you don't want to execute your trade here. Unlike the market execution, let's say you actually want to do the market order and then price is at this current price, meaning you just execute immediately at this current price. But for the pending order under the limit order, now you want to actually execute a sell trade, and then this is the current price, and then you don't want to execute at the current price. Then you will set your order above the current price, expecting that when price pulls back, price would activate your sell order, and then you would ride with price to the downside. So this is what you have to know about the limit order. So you can now see we have the stop orders category where you have the buy stop and then you have the sell stop. So basically for the stop orders, a stop order entry is actually an order placed to buy above the markets or sell below the market at a certain price. And you must understand that the stop orders are commonly used among breakout traders. So when you look at this chart here, you would see that this is actually the pending order type, which is actually the stop orders. So you know the pending order is actually into limit order, and then we have stop orders. So this is actually the stop order for the pending order category. Now what you can see for buy stop is that this is the current price. Now your intention to buy is actually that you don't want to buy at the current price. You want to buy above the current price. So you would set your order above the current price. So meaning when price makes a move to the upside and price gets to your pending order, it activates you, and then you continue with what? Price movement to the upside. So basically stop orders are more common among breakout traders. So when we move further into the technical perspective in Forex trading, you get to understand what really stands out for breakout traders. Now for the sell stop, you would see that this is actually the current price. But then you actually want to sell in the market, but you don't want to sell at the current price. And you believe that the market will keep moving to the downside. So you now set your pending order below the current price, believing that if this market is going to continue the movement to the downside, then when the market gets to your pending order, the market is going to activate your sell stop, which is actually your sell order, and then price continues to the downside to your expected target price. So you can see the difference between the limit orders and then the stop orders. In the limit orders, the buy limit is actually below the current price, and then the sell limit is above the current price. In the stop orders, the buy stop is above the current price, and then the sell stop, which is the sell order, is actually below the current price. So the next type of Forex order you have to understand is what we call the stationary stop loss. When you hear the word stationary, meaning it is static, it is not dynamic. For it to be dynamic, it means there have to be a force applied to it. So it is actually a stationary stop loss order where you execute your trade and then you place a certain price level where you anticipate that if price should breach that place, then the market should actually take you out of the market. So basically, the stationary stop loss order is a type of order linked to a trade for the purpose of preventing additional losses if the price goes against you. Are you getting it, guys? So this order would actually help you cut your losses short if it happens that your trade goes wrong. So what you can see here from this diagram here is that you see this is actually your entry price level, and then this is where the stationary stop loss is. The stationary stop loss is not movable. It is only movable when the trader moves it. So we have a type of order that is called a trailing stop loss order. We're going to get there. So now this is actually the entry price, and then this is your stop loss, and then this is now your target price. So we are assuming this is actually a price chart, and then you are in a long position, meaning you are in a buy market, in a bullish market. So you actually took your entry at this price level, you set your stop loss here, and this is your target price. Meaning if price is going in your favor, price should push to the upside to your target price. And then if price is going against you, the market is going to come to your stationary stop loss, and then you'll be taken out of the market. Meaning you see that the market is preventing you from incurring more losses in your position. If the market should go in your favor to your target price, meaning the market is going to close you in profits. But then if the market is going against you, it's going to close against you in loss. But then the market has prevented you, or let me say the stationary stop loss has prevented you from incurring more losses. So that is the advantage of the stationary stop loss. So it's actually a type of order that help you cut out your losses if it happens that your trade goes wrong. So stop losses can be applied regardless of whether you are entering with a market order or you're entering with a pending order. So actually stop losses are set at levels where when the price breaches it, you will be proven wrong. And basically these price levels could be near a recent high or low depending on the market condition. So I have to stress that statement. It depends on the market condition. The market may be bullish, so meaning that level where your stationary stop loss should be is actually at a swing low. And then the market could be bearish, meaning where your stop loss should be is actually at a swing high. So this is what you need to know about the stationary stop loss. So the next Forex market order that we have is actually what we call the trailing stop loss. From the word trailing, you would understand that it has to do with motion. It has to do with movements. It is dynamic in nature. The stationary stop loss is not dynamic. It is only movable when the trader decides to actually change the stop loss price level. But for the trailing stop loss, it is movable as price moves in your favor. It's a stop loss order that automatically moves once profit becomes equal to or higher than a level you specify. So what you can see from the screen here is that you can see here, we are actually in a short position, meaning you're in a bearish market condition, you're in a sell market. And then this is actually your entry price, 1.2140. And then this is your trailing stop loss level. You actually apply the trailing stop loss here, which is 1.2160, a difference of what? 20 pips. So this means that if the market should move 20 pips in your favor, this stop loss is going to move from 1.2160 to 1.2140. Meaning if this is your entry level and then the market should move to this price level, because what you can see here is a difference of 20 pips also. Your stop loss is 20 pips and then the market moved 20 pips. So meaning when the market moved from the entry price level to this price level, which is 1.2120, the stop loss is going to automatically move from 1.2160 to 1.2140, which is actually 20 pips. So if the market again move additional 20 pips from this price level, which is 1.2120, the market moved to the downside further by 20 pips. The stop loss that actually moved from this price level to this price level is now further going to move from 1.2140 to 1.2120. So you see why it is called the trailing stop loss. It is actually movable. It is dynamic. It automatically moves based on the specified pips value, or let me say price value you impute when you execute that trade. So this is what you need to know about the trailing stop loss order. So next we have that is what we now call the target price, which is what is called take profit, which is what is called TP. That's take profit, target price. So for the target price is also known as take profit level. So this order limits your gain, just as how stop losses limit your losses. So the target price helps limit your gain, just the way you see stop losses limit your losses. So the target price order is the order a trader activates in order to leave the market in profit without manually exiting the trade. So it is actually important for you to set a target price so that you won't act out of emotions when your trade is open. So you can see what we have here is this is the entry price level. We have the stationary stop loss. We have the target price. So this is the TP level. So it means just the way if this market should go against you to the downside, you're going to be taken out of the markets at this stop loss price level. The same thing applies to the target price. when the market is actually going in your favor and the market reaches your target price level, the market is actually going to close the position and keep you in profits. So that is why I would say, and I would stress this, that it is important for you to actually set a target price so that you won't act out of emotions when your trade is open. So in no way should your target price be tighter than your stop loss. No. Your target price should be more than your stop loss price level. Meaning when you're executing a trade, you should look forward to earning more than losing more in that trade. You should possibly target a 1-to ratio 3, meaning if you're actually risking 10 pips as your stop loss, then meaning your target price should be like 30 pips, which is 1:3 risk reward. So the next type of Forex order we have is what we call the manual exits. So you can actually understand from the word manual. This is when you exit the trade at a goal, whether at profits or at a loss. So these are actually the various types of Forex orders. So the next we are still going to be looking at in this episode is actually the types of analysis, the various types of Forex analysis. So for the Forex trading analysis, the various types of Forex trading analysis, or let's just generalize it as the various trading analysis we actually have, is we have the sentimental analysis, we have the fundamental analysis, we have the technical analysis, and then we have the intermarket analysis. These are just the analysis, or let me say the major analysis I do like you guys to know about: the sentimental analysis, the fundamental analysis, the technical analysis, and then the intermarket analysis. But we are going to dwell on the technical analysis in this particular mentorship program. For this episode, we're going to have a preliminary knowledge of the other 3 types of analysis. But as we continue further with this mentorship program, we're going to dwell more on the technical analysis. So when we talk about the technical analysis basically is the framework in which traders study price movements. It's as simple as that, whereby you make use of the trading charts, your MT4, your MT5, your trading view. As we continue further, you get to see the interface for the MT5, the MT4, the interface for the trading view. So basically, technical analysis is a framework in which traders study price movements. It's actually the study of historical data and charts in order for traders to make better educated trades. Technical analysis basically is the use of indicators or price action to determine the probability of future price movements. You're basically using price behavior from past and present to determine the future movements of the currency. This is used to determine the exact entry, the target price, and the stop loss points. So that is what technical analysis covers, and that is what we are going to really dwell on in this mentorship program. And you must understand that the methodology is actually the smart money methodology, which is actually price action trading methodology. So the next we have is the fundamental analysis. So the fundamental analysis is basically a way of looking at the Forex market by analyzing economic, social, and political forces that may affect currency prices. So it involves assessing the economic well-being of a country and by extension, the currency. So unlike technical analysis, where you are basing your decision on past price behavior, in fundamental analysis, you are speculating on the movement of the price based on the current and expected future state of the economy. So it's the using of data from economic, political, and societal factors. You can use this to determine the future price trend. So this is what you need to know about the fundamental analysis. It is the using of economic, political, and social factors, data to actually determine the future price trends. Then we have now the sentiment analysis. So the sentimental analysis is a measure of how traders and investors view the outlook for the markets and larger economy. So traders attempt to determine how market participants feel about a particular financial asset or the overall market. So one way you can do this is by identifying the net positioning of the big players in the markets. That's for the sentimental analysis. Since they are actually the ones who control a large volume of capital, they have the ability to move markets, especially when the liquidity is lacking. So you must understand that there is what we call the COT report. Basically, this is Commitment of Traders reports. And it is basically covering commercial traders and non-commercial traders. So the Commitment of Traders reports helps provide the valuable information on commercials and non-commercial traders' position. Since actually sentiment analysis is basically the study of behavior, the behaviors of the traders, the behavior of the markets. So the commercial traders refer to companies that are involved in the Forex futures markets to use it as a hedging mechanism, while the non-commercial traders refer to the participants who speculate in currency markets such as hedge funds and institutions. So basically, if you actually want to find these informations to help you establish your sentimental buyers, then there is what we now call the Commodities Futures Trading Commission. So when you check their website, that is where you can find the necessary information. So you can find the reports from the Commodity Futures Trading Commission websites. And once you actually go to this website, our concern is with the commercial traders because they are the trend starters. When they are actually selling, the markets would be buying. When they are buying, the market would be selling. So we pay attention to what the commercials are doing. Then we actually do the opposite. If the commercials are selling, the market should be buying. If the commercials are buying, the market should be selling. So this is what you need to know about the sentiment analysis or the sentimental analysis. Then the last we have is now the intermarket analysis, which is also known as cross-market analysis. So the intermarket analysis involves the analysis of more than one related class of assets, such as the stocks, bonds, commodities, and currencies. But, for this mentorship program, since we're actually dealing with Forex, foreign exchange, and basically we're dealing with currencies, not stocks, not bonds, not commodities. We're dealing basically with currencies. So the intermarket analysis involves the analysis of more than one related currencies. Basically, it is you studying the relationship between asset classes, and these asset classes may be negatively or positively correlated. So you can see we have them as positively correlated pairs or negatively correlated pairs. The example we have on the screen for positively correlated pairs is actually the Euro USD, GBP USD, and then for the negatively correlated pairs, we have USD CHF, and then we have the Euro USD. We're going to look at this with an example from the chart. So you can see here we have the chart for the positively correlated pairs, which is actually the Euro USD and then the GBP USD. What you can see is that you can see for the Euro USD, you can see it's trending to the upside here. And now you can see the relationship with the GBP USD. You can see the GBP USD trending to the upside. You can see we have this momentum movement to the upside. You can also see similar momentum movement to the upside in the GBP USD. So you can see how they are positively correlated. They may not really be so similar, but you can see that they have similar directional movements. So we can see we have this movement to the upside. We're having that here for the GBP. We have this pullback. You can see we have this pullback. So the volatility would be actually different for some of these positively correlated pairs. So now we can see for the GBP here, we have the push-up price to the downside, euro to push-up price to the downside. We have the up movement, we have up movement, a pullback, an up movement, pullback, up, and then we have this push to the upside, push to the upside. So you can see that the euro USD and then the GBP USD are positively correlated. So the euro USD and the GBP USD, for example, are positively correlated based on the example you're seeing, because the base currency, which is actually that is the euro and the GBP, they actually represent the European Union member states. So they are very, very similar, both from a monetary policy and from a geographical sense. In other words, when the euro makes a shift in monetary policy, or when there is a major change in the European economy, both the euro and the GBP are affected in the same way because they are both European countries. So now, when you look at the next example we have, which is actually the euro USD and then the USD CHF, what you're going to see is that these pairs are actually negatively correlated, because what you can see is the euro USD is trending to the upside here. What we can see is that what the USD CHF is trending to the downside here. You can see you have that momentum movement to the downside here, but in the euro USD we have a momentum movement to the upside. So this is what we call intermarket analysis. So you use intermarket analysis to confirm the buyers you're trying to execute in a certain currency pair. So basically, if you're looking to buy the euro USD, then you should be looking to sell the USD CHF for a negatively correlated pairs. But the positively correlated pair is, if you're looking to buy euro USD, then be looking to also buy GBP USD. So you can see now when we have the bearish movements here in the euro USD to the downside, you can see in the CHF, we are now having price pushing to the upside. Price was actually though ranging here, but you must know that it is ranging to the downside. Here, price too was ranging, but ranging to the upside. So you can see that the euro USD and then the USD Swiss franc, the CHF, is actually negatively correlated. So the euro USD and the USD CHF are negatively correlated because the base currency of the first pair, which is the euro, and then the base currency of the second, which is USD, have very different monetary policies, economy, and geographic locations. So for the same reason, the previous pairs are positively correlated, these pairs are negatively correlated. So that is what you must understand. So we have sentimental analysis, we have fundamental analysis, we have intermarket analysis, and then we have technical analysis. So in the course of this mentorship, you're going to dwell more on the technical analysis perspective. And we're going to be using the smart money concept trading methodology. So till I see you guys in the next episode, cheers and God bless you.